Okay, so good evening to you all. I think now we can start. Yesterday we looked at partnerships. We saw how to come up with the partnership accounts, how to come up with the appropriation account. We looked at how to prepare the partnership capital account, as well as the current account. We looked at how to come up with the balance sheet of a partnership business, and we say that when it comes to the balance sheet, in the equity section of the balance sheet, we have to present the capital account as well as the current account balances, as well as the current account, as well as the current account balances. Now, today, I want us to look at something new, but still under partnerships. Then we are going to look at goodwill for partnerships, as well as revaluation of assets of the partnership business. In other words, we are going to look at the structure changes that may take place in a partnership. Remember, yesterday we looked at the partnership agreement, and we said that sometimes there may be need to introduce a new partner. Now, if we are introducing a new partner, what could be the procedures? What happens if one of the partners is retiring? What happens if one of the partners has died? Those are the things which we are going to look at, those changes in the partnership business. We looked at how to come up with appropriation account, how to come up with a capital account as well as the current account, and then the statement of financial position. But we need to look at some more issues when it comes to partnership. So today we are looking at some of the changes that may occur in a partnership business. Okay. So we have different changes which we are going to look at. But the first thing we are going to look at is the goodwill for the partnership. We are going to see what goodwill is and why goodwill exists. We are going to look at the adjustments needed when there is some form of change in the partnership. Those are the learning objectives of this session. So we start with goodwill. What is goodwill? Who can tell us what goodwill is? Anything you know about goodwill or how you understand goodwill? Claire and Charlotte, goodwill. What is goodwill? Who can tell us what is goodwill? Lucas, goodwill.
I'm just going to try.
What is goodwill? Yes, you can try. You can try. Yeah.
Goodwill is it's in an intangible asset of which the company has made that name, like the existence of that name for some time. So like if you have new or someone to join the partnership or sharing the shares or something. So there's like kind of reputation that the company has made for a certain period of time.
Okay, that is goodwill according to Dorcas. Scovia, goodwill. What is goodwill?
Just like she has said, goodwill is a positive reputation, trust or value that a business has earned over a period of time.
That a business has earned over a period of time. Okay, positive reputation. Peter, Goodwill. Claire
Okay.
and Charlotte.
Goodwill.
Yes.
It is that the good name,
The good name, okay.
made by the business, but in most cases it is valued at the time when the business is being sold off to another party.
Value that when the business is being sold to another party. Okay. Yes, a good one. Lynn, for you, how do you understand goodwill? Scovia, sorry, Charlotte and Claire, goodwill. Okay,
Goodwill
now,
is
yes.
a long-term asset.
Goodwill is a long-term asset, yes. Okay, it's a long-term asset. Yes, you're right. Goodwill can be a long-term asset. Now, when it comes to goodwill, yes, you've said that it's an asset, but goodwill is an intangible asset, first of all. That's what we have to understand. Goodwill is an intangible asset. It's that asset which you cannot see, so it cannot be seen. It has no physical presence, okay? It has no physical presence. Unlike these other assets which we can see, the machinery, the vehicles, the premises, those ones you can see them, but goodwill is that asset which cannot be seen because it has no physical substance. Now, when a successful business is sold, when a successful business is sold, the vendor will generally price the business at a price greater than the total of the net assets being sold. So normally this goodwill arises when we are selling a business, already an established business, that business that has been successful for years, okay? So when you're selling such a business, you will price this business at a price that is greater than the total of the net assets being sold. So that is goodwill. In fact, here they are telling us that it can only exist if the business was purchased and the amount paid was greater than the value of the net assets. In other words, you're paying some excess. That excess amount you pay over the net assets, over the value of the net assets of that business you're purchasing, that excess you pay is what we refer to as goodwill. So it may represent the value of the reputation of the business at the time you are purchasing it. Okay? That is goodwill. Reasons for payment for goodwill. If I'm purchasing a business and we discover that what I'm paying, the price I'm paying is greater than the value of the net assets of the business I'm paying, why do I have to pay for that extra? Why do I pay that extra price? Okay, why do I have to pay that extra price? So in buying an existing business which has been established for some time, there may be quite a few possible advantages. Some of them are these advantages which we see. These are some of the reasons as to why you may end up paying for goodwill. One of them, a large number of regular customers who will continue to deal with the new owner. So if you're selling already an existing business, you have to look at also this, okay? We have these regular customers. They will continue coming to deal with the new owner. So as we are selling our business, we have to value also this. The business has a good reputation. The business has a good reputation. You also have to consider that reputation of the business. Look at the experienced, efficient, and the reliable employees. The business is situated in a good location. Okay? All these have to be considered when pricing this business. So a good strategic location, it has good contact with the suppliers. You also have to consider the suppliers. It has a well-known brand name that has not been valued and included as an asset. So all these brand names have to be valued at the time when we are selling this business. These are some of the reasons as to why there may be need to pay for goodwill. However, one thing you need to know is that if the business is new, these advantages may not be available to a new business. They are available for that business that has been existing. It has been there for some time. It has been successful. Then you expect to see such advantages. But for a new business, these advantages may not be available. So those are some of the reasons as to why the purchaser of the business may end up paying for what we call goodwill. Now we need to know, okay, what happens in the partnership books if there is goodwill? And when do we introduce this goodwill in the partnership books? Because yesterday we saw there was no any goodwill. We didn't talk about goodwill. But then now, why are we introducing goodwill in the partnership books? Or when do we do that? Although goodwill is not normally entered in the financial statements unless it has been purchased, sometimes it may be necessary where partnerships are concerned. So where we have partnerships, it may be necessary to introduce in goodwill in the partnership books. When do we introduce that goodwill? When do we introduce that goodwill? So whenever something happens, such as what? The existing partners decide to change their profit and loss sharing ratios. We have been in a partnership business, assuming me and you, we have been sharing our profits equally, but now we are like, no, let us change the profit and loss sharing ratios. I'll get 3/4, you'll get 1/4. So whenever there is a change in the profit and loss sharing ratios, then we have to introduce goodwill in the partnership books. We have to introduce goodwill in the partnership books. A new partner is introduced. If we are introducing a new partner, then we have to introduce goodwill in the partnership books. We have to introduce goodwill in the partnership books. We have to introduce goodwill in the partnership books. Then the other point is when a partner retires or dies, when a partner retires or dies, then the ownership of goodwill by the partners changes in some way. So those are the circumstances under which we may introduce goodwill in the partnership books. Those are some of the circumstances or the scenarios when goodwill may be introduced in the partnership. Change in profit sharing ratios of existing partners. What do you think are the reasons for the change in the profit sharing ratios? Why do we change these ratios? What may be the reason as why we change these ratios? Claire and Charlotte, why do the partners change their profit and loss sharing ratios? Yes. Why maybe they need to change the profit sharing ratios of the existing partners? Peter?
Yes.
Reasons
Now,
for change of profit rate? Yes, please.
for example, there might be change in the duties and responsibilities of the partners.
Okay.
For example, a partner maybe added more duties or responsibilities.
Okay.
Change in the form of change in the type of partner. One may be, for example, has been a nomadic partner becomes an active partner.
Okay.
Even when partners decide to contribute more capital, that is in the cost of operation.
Okay.
We can decide to change the profit and loss sharing ratio.
Okay, so those may be some of the reasons as to why there may be changes in the partnership profit sharing ratios. But according to what we have, the typical reasons are a partner may now not work as much as in the past. Okay, a partner may now not work as much as in what? As in the past. Possibly because of old age or ill health. Then the partner's skills and ability may have changed. Okay, perhaps after attending a course or following an illness, then the partner may not be doing much more of the business, much more for the business than in the past. So these may all be reasons as to why there may be changes in the profit sharing ratios of the existing partners. Now, which adjustments do we make when accounting for goodwill? Which adjustments do we make when accounting for goodwill? Now, there are two methods of accounting for goodwill. There are two methods of accounting for goodwill in the partnership books. We need to look at these two methods. One is goodwill account opened. That is the first method which we can look at, goodwill account opened. This is also known as the revaluation method. It's also known as the revaluation method. Now, what do you do when it comes to the revaluation method? Now, in this case, you have to open a goodwill account. You have to open the goodwill account. Then you make the following entries. You debit goodwill account with the total value of goodwill, and then you credit the partner's capital accounts, each one with his share of goodwill in the old profit sharing ratios. So that's what you do when it comes to the revaluation method. You open up a goodwill account, then you debit the goodwill account with the total value of goodwill. Then that same value is credited to the old partners in their profit, in their old profit and loss sharing ratios. Meaning that the new partners have no share in the goodwill if you use the revaluation method. The new partners have no share in the goodwill. That is, if you use the revaluation method. So this is what you do when it comes to the revaluation method. Let us see what will happen, how to work out the goodwill when it comes to the revaluation method, how to make the necessary adjustments. when it comes to the Goodwill, the revaluation method. So in your books, possible, you can put this down. Let us try to put some small notes there. We can say Goodwill. So you can say Goodwill. In partnership books, the first method is known as the revaluation method. Now, when it comes to the revaluation methods, first of all, we create the Goodwill assets. In the partnership accounts. So we create the Goodwill asset, the partnership accounts. Then we open up the Goodwill account and we debit the Goodwill account with the value of Goodwill. Then we credit the old partners, capital accounts with the share of with the share of Goodwill. In brackets, we use all the profits stroke loss sharing sharing ratios, simply because we are sharing this Goodwill to the old partners, among the old partners, using their old profit or loss sharing or loss sharing ratios. Sometimes it may be required to prepare the Goodwill account. So that Goodwill will be taken to the capital account, assuming I have A and B as our partners. They have been sharing profits and losses in the ratio of a half. So times the Goodwill. So you get their share. Okay. So you see that Goodwill, the Goodwill assets in the partnership accounts. So this balance of Goodwill will be taken to the statement of financial position as what? As an intangible asset. It will be taken to the statement of financial position as an intangible asset. So these are some of the these are the adjustments which you make when you're using the revaluation, method. You have to create Goodwill asset in the partnership accounts. So you have to open up a Goodwill account. When you open up this Goodwill account, you debit Goodwill account with the value of Goodwill, and then credit the old partners capital account with the share of Goodwill. That is according to their profit or loss sharing ratios. Then this will be the format of the Goodwill account, as you can see. So you debit it with the shares of Goodwill for the different partners, that is A and B. Then you balance up the account. That balance will be taken to the statement of financial position as an intangible asset. Now, what happens if I'm to come up with the partner's capital account? How do I present this? So this is partner's capital account. The presentation, the partner's capital account, if I'm using the revaluation method. So we have details. I have A, I have B. Details, I have partner A and partner 1 and partner B. Okay. So in the partner's capital account, we have said we shall credit this partner's capital account with the partner's share of Goodwill. Okay. So I'll come here and write, we credit, this is debit, remember, this is the partner's capital account, then this is credit. So I'll come on the credit side, the details, I write Goodwill, then I put the share of A and the share of what? And the share of B. So here I'm just completing double entry that I've debited the Goodwill account this, and then I've credited the partner's capital account with their shares of Goodwill. So that is the revaluation method of Goodwill. Okay, revaluation method of accounting for Goodwill in the partnership books. I don't know if you've done with summarizing this, or you can take screenshots, but this is how you deal with a Goodwill if you're using the revaluation method. Revaluation method simply means that this Goodwill is to be maintained in the books of accounts of the partnership. Okay, so the Goodwill will remain there in the partnership books. It's going to be carried in the books. Okay, yeah. So that is Goodwill and the revaluation method.
Senior,
Yes, please.
can I please see the last the partners capital, the last draw?
Okay,
yes,
there.
I need to take a screenshot. Done.
You're done? Okay, so let us go and then we see the second method. But that is the revaluation method. Yeah, so you debit the Goodwill account with the total value of Goodwill, and then credit the partner's capital accounts, each one with his share of Goodwill in all the profit sharing ratios. Now, the second method, this is where Goodwill is to be maintained in the books of the partnership business. Goodwill is to be maintained in the books of the partnership business. And the method in this case is known as the Memorandum Revaluation Method. The method is known as the Memorandum Revaluation Method. Now, in this case, you open up the Goodwill account, then you make the following entries. You debit Goodwill account with the total value of Goodwill, then you credit the partner's capital accounts, each one with his share of Goodwill in all the profit sharing ratios. So this is the same as the other revaluation methods. Okay, but remember here we are not going to do what? We are not going to maintain Goodwill in the books of account. In fact, this goodwill is to be maintained in the books of the partnership is part of the revaluation method. Yeah, it's part of the revaluation method. Then the second method is memorandum revaluation method, where goodwill account is not opened. But what we do, we normally open the goodwill account, but we just write off the value of goodwill immediately. Okay. So after debiting the goodwill account with the total value of goodwill and then crediting the partner's capital accounts, each one with his share of goodwill in the old profit sharing ratios, then we have to go ahead and debit the partner's capital accounts, each one with his share of goodwill in the new profit sharing ratios. So you see on the credit of the partner's capital account, we use old ratios. Then on the debit of the partner's capital account, we use the new ratios. We use the new ratios. Then we credit the goodwill account with the total value of good, with the total value of goodwill. We credit the goodwill account with the total value of goodwill, with the total value of the goodwill. Let me still take you back and I show you what would happen. How would we present our goodwill if it was the revaluation? If it was memorandum revaluation method. Okay. So this is method 2. That is memorandum. So the examiner will specify the method you to use. They can either say you to use revaluation method or memorandum revaluation method. So you have to look at the question and see which method you to use. So memorandum revaluation methods. Now, when it comes to this method, normally goodwill is eliminated. Goodwill is eliminated from the partnership books, i.e., no intangible asset carried. I.e., no intangible asset done what? No intangible asset carried. No intangible asset carried. Okay. So it is eliminated. It is eliminated by what? By a credit entry. It is eliminated by a credit entry in the goodwill accounts. In the goodwill accounts. And debit entries. And the debit entries are in the partners, and debit entries in the partners capital what? Capital accounts based on the new profit and loss sharing ratios. Remember, we said that goodwill we introduce goodwill, and it has to, when we create the goodwill account, we have to debit it with the total value of goodwill. but this goodwill is shared by the old partners. And I told you that this goodwill in the partnership books, it may arise if we are introducing a new what? If we are introducing a new partner, or if there is a change in profit or loss sharing what? Or loss sharing ratios. Now, if I'm using the memorandum revaluation method, this will be the layout of your goodwill account. So this will be the debit and credit. Assuming I have, because it will be taken to the capital account, as we have said initially. So I have my A and B. They have been sharing a half. Those are the ratios before. That was our value of goodwill. Now I have the partner's capital account. I have A and B. This is our partner's capital account. This is just for illustration purposes. Details. So we create this goodwill initially, and you already said that we debit the goodwill account and then credit the partner's capital. What we credit the partner's capital account with their shares of goodwill as per the old ratios. But now here the notes have told that it is eliminated by a credit entry in the goodwill account and debit entries in the partner's capital accounts, but based on the new profit and loss sharing ratios. So if I want to eliminate it from the books, I'll come and debit and credit the capital account. I'll come in the goodwill account and I credit it. Assuming now the ratios have changed in the 3 quarters times my goodwill, maybe a quarter times goodwill. It means that the debit will equal to the what? The debit will equal to the credit. Then I have to complete double entry and I go to my partner's capital account and then debit the goodwill. So here we have written off our goodwill. Why? Because in the goodwill account, there is no any balance to maintain. The debit equals to the credit. On the debit, we are showing the share of goodwill to the partners using their old ratios. On the credit, I'm showing the goodwill shares using the new ratios. So the debit equals to the credit, the same value which we are sharing. So there will be no balance to maintain in the books of the partners, in the books of the partnership business. So here, goodwill is written off. We write it off by crediting the goodwill account and then debiting the partner's capital account based on the new profit and loss sharing ratios. So in this case, no intangible assets. No intangible assets for goodwill in the statement of financial position because it has been eliminated. Okay? Because it has been eliminated. Because it has been eliminated. It has been eliminated. So that's what happens when it comes to the memorandum revaluation method. The examiners normally will state which method you're going to use. They can say, maybe it's the policy of the partnership, the policy of the partners to maintain the goodwill in their books, or the partners do not wish to maintain goodwill or to carry on goodwill in their what? In their books, in which case you have to use the memorandum revaluation method. So this is what will happen when it comes to the memorandum revaluation, when it comes to the memorandum revaluation method. You can summarize that, or you take a screenshot very fast, then we see what next we can look at after this. So are we done with this?
Kindly scroll up slightly.
There?
No, I meant down, sorry. Yes. What is SOFP?
That is statement of financial position.
Okay.
Yeah. That is statement of financial position. Okay, so that is the memorandum revaluation method. We need to see now what next. So in that case, goodwill is not maintained in the books of the partnership business. Of course, we have seen that. Goodwill is not maintained in the partnership, is not maintained in the partnership business. From there, we move to the admission of new partners. Admission of new what? Admission of new partners. Admission of new partners. Now, new partners may be admitted in the partnership business, usually for one of the two reasons. Usually for one of the two reasons. Roman one, as an extra partner, either because the firm has grown or because someone is needed with a different what? With a different skills. Yes. So sometimes maybe the business has grown, then we may introduce a new partner, maybe because someone who is needed is to be having different skills, which skills the existing partners may not be having. So you may decide to introduce a new partner with such extra skills, or simply because of growth in the size of the business. Then also to replace a partner who is leaving the firm. Okay, to replace the partner who is leaving the what? Who is leaving the firm. So if a new partner is leaving the firm, then we have to replace, or we may need to replace that partner with someone new. So that is when we may introduce, or when we may admit a new partner in the partnership what? In the partnership for business. Of course, there is an important note that on admission of a new partner, the new partner pays some cash. Yeah, the new partner pays some cash for his or her capital contribution. For his or her capital contribution. Now, this new partner who is paying this extra cash for capital contribution, we have to record that capital contribution in the books of the partnership. So normally what we do, we debit the cash or bank account, and then we credit the partner's capital account. Okay, we credit the partner's capital, we credit the partner's capital account. Of course, now the next part will be about revaluation of assets, but allow me to do something about goodwill. Let us look at an example. Then we see how we can introduce, how we can account for goodwill. This is what we did yesterday about coming up with the income statement, the appropriation account, as well as the partner's capital accounts and the current account, as well as the statement of financial, position. But now let us look at goodwill. Let us look at goodwill. So we have this question. Scovia, you can read for us this. This is the question we have. I shared these questions in the group yesterday. So you can read for us this, and then we see how we can come up with our accounts.
Oh, I'll request that someone else should.
Okay. Peter, Peter, you can help us on try to take us through this, read through this, then we'll see what we can do.
Okay. The partners have to change their profit ratios as shown. Mark, okay, there's the old ratio and the new ratio. Mark, partners have Mark, Barnes, Print, and Tonks. Mark old ratio is 1, the new ratio is 2. Barnes old ratio 4, new ratio 3. Print 2, then new ratio 4. Tonks 3, new ratio 1. They decided to bring in a goodwill amount of shillings 72,000 and a change. The last balance sheet before any element of goodwill has been introduced was balance sheet 2002, net assets including goodwill 180,000, capitals Mark 30,000, Barnes 70, Print 34,000, Tonks, and the total is of course 180. Should have balance sheets on 1st October 2002 after necessary adjustments have been made if goodwill account was opened. That's part A. Then part B, goodwill account was not opened. Yeah, I think that's all.
Okay, thank you. Now we look at part. Okay, yeah, thank you so much. We look at part A, goodwill account was open. Which method are we going to use here? Which method are we going to use there if the goodwill account was opened?
Revaluation.
So part A, I'll use the revaluation method. Then part B, I'll use which method?
Memorandum. The memorandum revaluation method.
So here we use the memorandum revaluation method. Okay, so this is our scenario which we have. These were partners, they were 4 partners before, and they have their old ratios, as you can see them. They have been sharing their profits and losses in the ratio of 1 to 4 to 2 to 3, but now they are changing to the new ratio, which is 2 to 3 to 4 to 1, okay? So now because of the change in the ratios, they decided to bring in the goodwill amount of how much? Of 72,000 pounds on the change. The last balance sheet before any element of goodwill has been introduced was, so this is their balance sheet, as you can see. Net assets, but these do not include goodwill. Then we have been told to show the balance sheets on 1st October 2002 after necessary adjustments have been made if part A goodwill account was opened and then part B goodwill account was not what? Was not opened. So I'm going to start with part A. I'll start with part A. Start with part A. So on part A, this is what we are going to do. Part A. I'll say part A. This is our part A. Goodwill account is open. So you prepare the Goodwill accounts. Who are the partners in this case? Who are the partners members? We have Mark, Barnes, Flint, and Tonks. Those are the partners. So this is our capital account. That's our capital account that we have to show. We have to show what? We have to show the shares. We have to share that goodwill. How much is the value of goodwill? 50 what? It is 72, right?
72.
72. So the capital account, the partners, we have Mark, we have Barnes, we have Flint, as well as what?
Yes.
As well as Tonks. The ratio is 1 over what? What is the total? What is 1 plus 4 plus 2 plus 3? That is 10. It is 1 over 10 times the goodwill, which is 72,000. Then Barnes is 4. Then Flint is 2. And then Tonks is what? Is 3. Okay, so do the math, please. 1 over 10 times 72, that's how much? One over 10 times 72,000, that's how much?
$7,200.
That's how much?
7,200.
7,200. 7,200. Okay. So this is 7,100. Then for Barnes,
$28,800.
98.
It is 28,800.
Okay. Then Flint,
The print in, what is it?
14,400.
14,400.
Uh,
14,400. Then Tonks,
what is it again?
21,600.
21,600. Sure.
21,600. Let me see 3.
It's 21,600.
21,600.
Yeah.
Yes.
Okay. Now here the Goodwill account was opened, and remember I told that here we are using the memorandum revaluation what? We are using the revaluation method where the Goodwill account where the goodwill is introduced and it has to be maintained in the books of accounts, say, if you use the revaluation method. So meaning that we have to balance off the account we have to balance carried down. That will be 72,000. Okay. So meaning that at the start of the next period, that is on 1st October 2002, because let me see when the change was made. Okay, assuming these changes were made at the start, show the balance sheet on the 1st October. Okay, so assuming, okay, this is our date, the commencement date, then there will be that goodwill of 72,000. So here we are carrying this goodwill and it is to be maintained in the books of accounts. Okay. As I told you, this will be taken to the statement of financial position as what? As an intangible asset. Don't forget. Now, the next thing which I have to do, I have to prepare the partner's capital account, because we have to complete double entry, and you complete the double entry in the partner's capital account. We have to credit the partner's capital account with their shares of goodwill. So, partner's capital account. The partners are many. We have let me just say Mark. Let me just use the first letter. This is Mark. We have Barnes. We have Flint. Then who else? Tonks. Then details. I have M, B, F, and then T. This is debit, this is credit. Now, of course, the partner's capital account, you start with the balance brought down, and that's a credit. You get this balance brought down from where? From the opening balance sheet. These are the balances: 30, 70, 35, and then 45. 30, 70, 35, then 40, then 45. So let's enter that balance, the opening balance. Let's enter our opening balance. We have seen that Mark is 30,000. Then B, that is 70. Then F, that is 30 what?
35.
35,000. Then T, that is Tonks, that is 45,000. Then I'll bring their share of goodwill. I'll bring their share of goodwill. Then we'll credit it in the account. Mark is 7,200. bonds is 28,800, 14,400, and then 600. Of course, you balance the account up, you balance it off. 30 plus 72, that is how much? Let us balance off this account.
100. 2,000.
Let us balance off the account.
100, 200.
Yeah, we have 100 what?
37 and 200.
37, 200. Then for B,
98, 800.
B is 98. 800. Then F,
49, 400.
49.
400.
Then T,
It is
66.
66, 600.
Okay, 66, 600. So the totals, this is the balance brought down for M. That is the partner's capital. That's the partner's capital account. That is the partner's capital. That is the partner's capital account. That's the partner's capital account. Now, maybe what we are going to do now, we can come up with our balance sheet because they want us to prepare the balance what? Show the balance sheet as on 1st October 2002. Let us prepare that balance sheet here. Balance sheet as at 1st October 2002. Balance sheet as at 1st October 2002. So according to the original balance sheet, you have the net assets figure. Net assets are how much? 180,000. Okay. So you bring the net assets as well. $180,000. Then you also bring goodwill, which is an intangible asset. How much is the value of goodwill? We have seen from our goodwill account that goodwill is 72,000. So you bring that 72,000. Then you get your total what? Total assets. How much is the total assets figure now?
$250,000.
252.
How? 200? 200 what? 52, eh?
Yes.
252,000. 252,000. 252,000. Then you go to the capital what? Go to the capital account. Go to the capital accounts. Capital accounts. Under the capital accounts, you have what? You have Mark. You can read for me the names of those partners. We have
Mark, Barnes, Flint, and Tom.
Mark, Barnes. Then what else?
Flint and Tom.
Flint and
Tom.
And Tonks. Okay, and Tonks. Remember, there have been some changes. We have introduced Goodwill, and their capital account balances have now increased. So check from your capital account balance, how much the balance of Mark?
37,200.
37,200. 37,200. Then Barnes?
98,800.
90? It's how much?
98,800.
98,800. Then Flint?
Yes.
Flint is
Flint
how
is
much?
49,400.
49,400. Then Tonks?
66,600.
66,600. $66,600. Total capital is how much?
$252,000.
252,000. 252,000. So that is the memorandum, that is the revaluation method. So you see, when you use the revaluation method, your goodwill will appear. Okay, your goodwill will appear in the statement of financial position as a non-current what? As a non-current asset, as you can see. Your goodwill will appear in the statement of financial position as a non-current asset. Then the other thing is that if you use the revaluation method, then the partner's capital accounts are going to increase. Okay, the partner's capital accounts will do what? Will increase. They will increase simply because these partners, they are getting a share of goodwill. Okay, so this will increase their capital. This will increase their capital account. Here we have debited. So the double entry is completed in the partner's capital what? In the partner's capital account. So you debit the goodwill account, then you credit the partner's capital, you credit the partner's capital account. Then here I told you that the goodwill, this balance of 72,000 will be taken to the statement of financial position as an intangible asset. And we have seen this here in our statement of financial position. So that is how you can use the revaluation method. Okay. Maybe now what we are going to look at is the second method. I don't know if you've summarized this. I want us to look at the second method, that is the memorandum revaluation method now. Memorandum revaluation method. Okay. Memorandum revaluation method. So are we done with summarizing this? Now I have some friends who are on those who are on YouTube, those who are watching from YouTube. I know some of you have no questions. I see someone is asking, where is the question? Can you share the question? On YouTube, I may not be able to share the questions, but you can WhatsApp me, then I send you the questions. Someone was asking on YouTube that can you please share the questions? Please, I cannot share the question on YouTube, but you can inbox me, then I share the question maybe on your WhatsApp. This is Chilabo Karen Kanisha. Yes, you can inbox me on WhatsApp, then I share the question, Chilabo. Thank you for watching. Okay, members, let us look at part B. Goodwill account was not opened. Let us look at part B. Have we summarized the first part? The solution for the first part? Charlotte, have you summarized the answers? Mary and Jane, Lynn, have you summarized this? We want to look at part B.
We are through.
You're through. So let us look at part B. Okay. Let us look at part B. Now, this is just for illustration purposes. For illustration purposes. For exams, of course, we shall look at those examination style questions. But this is just for illustration purposes. How you can deal with goodwill. But the question may not be like this when it comes to exams. This is for illustration purposes. But of course, after looking at this, then we have to get some exam style questions and then we see. Okay. Yeah. So I just want us to first get the concept. Then after we shall get out those past paper questions and then we see how the examiner sets partnership questions where we have the goodwill and maybe other stuff as we are going to see. So let us look at the goodwill account, but while using the memorandum revaluation method. So now I'm going to look at part B. So this is part B. Goodwill account was not opened. So I'll just make some okay, this will still be this time around. There will be no goodwill in the balance sheet because we have to write it off. So there will be no goodwill in the balance sheet. Okay, so let us now see what happens when it comes to part B of the question. Goodwill account was not opened. So goodwill account was not opened. Goodwill account was not opened. Now, here, what they are trying to mean that you write off goodwill, okay? They are trying to mean that you write off good what? That you write off goodwill. You write off good what? You write off goodwill from the partnership books. You write off goodwill from the partnership books. So we say that initially you debit your goodwill account using the old ratios. So here we used the old ratios. But we are going to write off goodwill by crediting the goodwill account. So capital account, this is Mark, Barnes, Flint, and Tonks. We have to credit the goodwill account. Now here what we want to do is to write it off. What are the new ratios? Peter, what are the new ratios?
New ratios.
Yes.
2, 3, and 1.
2, 3. What is the total? What is total? I think it is
10.
still 10. So that is 2 over 10 times our 72. Then 4 over 10 times 72. Sorry, this is 3, right?
That is 3.
This is 3 for Barnes. This is 3. Then Flint. Flint is 4.
4.
Then Tonks.
1.
Okay, 1 over 10 times 72, that is 7,200. Then 4 over 10, this is 28. Then this is 2. 2 over 10 times 72, this is 14,400. Then 2, sorry, this is 3, I think. This is 3. This should be 21. 21. This should be 21. 600. Then 2 over 10, this should be 14. 400. 2 over 10. So you see, here we have written off our goodwill. We have written off goodwill because now there is no any balance you're going to maintain in the books. There is no any balance you're going to carry because the debit equals to what? Equals to the credit. Debit, you have 72, then credit, you have 72. Here you have used the new ratios, please don't forget. When you're writing it off, you credit the goodwill account using the new ratios, okay? Using the new ratios. Using the new what? Using the new ratios. Using the new ratios. So that is the goodwill account. Now, when it comes to the capital account, you have to complete our entry. So this comes this side as you saw. Then this will be debited. Okay, those will be debited. So details goodwill. So this is 14,400, 21,600, 28,800, and then 7,400. Okay. Then you balance off the goodwill account and get your balance carried down. Let us get a balance carried down. Normal balancing of an account, don't forget. Normal balancing of the goodwill account. Sorry, normal balancing of an account. So what would you think would be the balance carried down for the partners after entering in the goodwill on both sides? So 37,200 minus what? Minus 14,400. This gives us straight what? This is 22,800. Then what? 98,800 minus 21,600. This gives us 70 what? 77,200. Then 28,800. Sorry. 49,400 minus 28,800. This gives us 2,600. 2,600. Then 45,000 plus 26,600. Oh, 21,600. Then minus 7,200. This gives us 50 what? 59,400. Then balance brought down 28,800, 77,200, 2,600, then 59,400. Those will be the balances. Those will be the balances brought downs. Okay. Those will be the balances brought. Those will be the balances brought down. Now you can go and complete your balance sheet. You prepare your balance sheet. This time around, you don't have goodwill because under this method, we write it off. It is eliminated from the partnership books. I will just bring my 180,000. That will be the total assets figure.
Senior.
Yes, please.
What do senior?
From where?
Edayuma bigakati. Awo wenyine wokolede. Awo wenyine awo wokolede balancing figures. Kuchinachi.
Normal balancing of the T account. One side is greater than the other. Okay. So you get the totals on the credit, then you minus this goodwill 14,400. For example, for M, I'll get the total on the credit, which is 37,200, right? Then minus the 14,400, then we get the balancing figure as 22,800.
Okay. Let me take the screenshot.
No, yes, there is taking the screenshot, but I also want you to see how we come up with those figures. So it's just normal balancing of an account. Eh?
Okay.
Yeah.
Got
One side is greater than the other, so you balance off the accounts, you find out the balancing figure. You insert the balancing figure on the smaller side. It's what we are trying to do here.
Okay.
Yes, please.
Got it.
Okay, so from there now we can do the balance sheet. Under the memorandum revaluation method, no goodwill because we have said that goodwill is to be written off. Don't forget, we have to write off the value of goodwill. Now, when you go to the capital accounts, you bring the balances from your capital account. Peter, how much are the balances? Mark, Barnes, Fleet, and Tonks. How much are those balances? Scovia, how much are the balances? Jane and Mary, Claire, Charlotte. Mark is how much?
22,800.
Mark is 22,800. Then Barnes?
77,200.
77,200. Then Fleet?
2,600.
Fleet is 2,600. Then Tonks?
59,400.
59,400. Will you get the total? How much is your total?
180.
180. 180,000. So that is your balance sheet. So you can see the differences. Okay. Here we don't show goodwill as an intangible asset in the statement of financial position if you use the memorandum revaluation method. Okay. So normally they will state in the examiner will state which method you're going to use, either the revaluation method or the memorandum revaluation method. Okay. Yeah. So we have like some 7 minutes here. We have 7 minutes. The next thing, are we done with summarizing this? You take screenshots for this. I don't know if you've been writing, but this is what we have. Under this method, you need to note down the differences between these two, between the two methods. The random revaluation method as well as the goodwill, as well as the revaluation method. So that is goodwill.
Senior,
Yes,
there where
please.
the before the capital. Up
Yes,
there,
yeah.
there.
Total
So
assets.
it's the net assets, then just nothing else.
Nothing else. This time around, we don't have goodwill.
Okay. Okay.
Now, can I have a look at data capital account app?
The capital accounts.
Which one?